Interestingly, everybody in the United States is subject to the passive activity loss rules, but nobody really realizes it until they buy rental real estate.
All right, Brandon, we are now into the nitty-gritty information. So let's talk about real estate tax and depreciation and in general how this all works.
Yeah. So let's build a fundamental understanding of real estate tax, and then we can expand into the short-term rental loophole and why that's important. So first, when you buy a rental, the rental is obviously going to generate rental income. Hopefully, you'll generate rental income. Then you're going to have some operating expenses, right? So you're going to have like insurance and taxes and interest, and that might be above or below the line. We can argue about that later, but regardless, management fees, repairs, that type of stuff. So you're going to have all these operating expenses, and then you have depreciation, right? So what happens with rental real estate is I might buy, let's call it a single family home. It might gross $10,000 in rent, and my operating expenses might be like $7,000, right? So my net operating income and or my cash flow, depending on how I financed the property, is $3,000 in this example, right? $10,000 of rent minus $7,000 of OPEX. So $3,000 is my NOI, it's my cash flow, but not included in that calculation is my depreciation expense. So depreciation is this phantom expense that I get to claim every single year that I own the property. And it's kind of like as a, think of it as like a thank you from the government for investing in real estate. It's an incentive for people to buy real estate. And here's how depreciation works. And before I explain how it works, depreciation is meant to track the deterioration of the components that make up your property over time, right? So real estate appreciates in value. The market increase, the demand increases, land is scarce, so real estate appreciates in value. But it's also true that your roof literally falls apart. The windows literally fall apart. The carpet, the bookshelves, everything falls apart, wear and tear. So depreciation is an expense that I get to claim on my P&L every single year, meant to track that deterioration. And so here's how it's calculated. If I buy a property for $100,000, I have to allocate that purchase price between building and land. Okay, because land is dirt. Dirt does not depreciate, right? It does not deteriorate over time. So I can't depreciate land. So let's just say that 20% is allocated to land. I'm just making these numbers up. And if you have an accountant that's making numbers up, that is a mistake. So if you were to hire our team, we would not be making this up. But for the sake of this example, we're just going to make it up. So 20% allocated to land. That means $80,000, again, $100K purchase. So $80,000 is allocated to the building. And I calculate my depreciation expense by just taking $80,000 divided by 27 and a half years. Why is it 27 and a half years? Because that's what Congress says, right? So those are the rules that they wrote. So that's my annual depreciation expense. That's how you calculate depreciation. $80,000 of improvement value, building value, divided by 27 and a half years. And so if we take it back to this $10,000 of rental income minus $7,000 of operating expenses, let's say that the property that I purchased, when you do that calculation, and I'm not going to do it off the top of my head. So if you're actually doing $80,000 divided by 27 and a half, this might not fully align, but 10,000 minus 7,000 of operating expenses, 3K of cash flow. But let's say our depreciation expense was like $4,000. Now what's happened, right? I don't pay any tax on the cash flow because I tell the IRS that I actually lost money on the property. $10,000 of rental income minus $7,000 of OPEX minus $4,000 of depreciation equals negative $1,000. So that's what I'm telling the IRS. I tell them I lost money, even though I made money. That's the beautiful thing about investing in real estate. So I've got cash flow that I'm not paying tax on today, and I also have a $1,000 tax loss thanks to this depreciation expense. And now I have to figure out, can I use that tax loss? And you might be thinking, well, $1,000 tax loss isn't that exciting. That's true. But maybe if you do it times 10, times 20, times 30, it starts to get pretty exciting, right? So this is something that we keep redeploying as we scale our portfolios out. And whether or not I can use that $1,000 is essentially the basis for the rest of this training that we're doing here today.
And so, love that. By the way, 27 divided by 80,000 divided by 27 works out to $2,962, something like that. So you were
Oh,
close,
okay.
close-ish.
Not bad.
I
Yeah.
I didn't I
All
did
right.
the math. I used
We
Google
need
for
like
that one.
$30,000 or something like
Yeah,
that.
yeah, exactly.
I'll change it
So,
for my future speeches.
all right, sounds good.
Yeah.
Um, so that is the deduction. That is the depreciation. We also want to talk about passive versus non-passive. If you can explain that a little bit. I know we'll go deeper into it, but just the overview.
Yeah. So, okay. So in this example that I just used, we've got 10,000 of rental income, $7,000 of OPEX, 3K of cash flow, but we also have this $4,000 of depreciation expense we get to layer on top. So even though I've got 3K of cash flow, I'm still telling the IRS I lost $1,000. Now the question becomes, can I actually use that $1,000 today, or does it get suspended and carried forward? And that's where the passive activity loss rules come into play. So interestingly, everybody in the United States is subject to the passive activity loss rules, but nobody really realizes it until they buy rental real estate. And the passive activity loss rules were implemented in 1986, and they were specifically implemented to prevent rich people from using real estate to reduce their W-2 income. Okay, so this concept of, can I use the $1,000 tax loss or not, or does it get suspended and just carried forward? The default answer is it's going to get suspended and carried forward. You cannot use the $1,000 tax loss from that depreciation expense. But there are exceptions to the rule, right? If we qualify as a real estate professional, we can use the $1,000. Or if we're running a short-term rental and we qualify for the short-term rental loophole, we can use the $1,000. And so again, like if you can get into a situation where you can actually use the tax loss from your rentals, then you can do things like accelerating depreciation through a cost segregation study. And now that $1,000 might turn into $20,000 or $50,000 or $100,000 of tax losses. And if you just think about using a $50,000 tax loss to offset your W-2 income, apply your marginal tax rate, maybe that saves you $15K in taxes at the federal level. Maybe it's another $5 at the state level, depending on your state. Some states decouple from bonus depreciation, so you do have to understand the state application. But it gets pretty lucrative pretty fast, and it can really enable you to buy property and immediately pull cash back out via a tax refund. And so that's where we do a lot of our planning with our clients, is helping them understand the passive activity loss rules, and then how to qualify as a real estate pro or how to run that short-term rental loophole so that we can use that tax loss that's generated from the depreciation.
Perfect. And that's exactly what we're going to get into next, is the rep status versus the STR tax loophole. But before we do, I got one clarifying question that I'm learning as we're going through this. So what you stated was that I was only allowed to carry on that extra $1,000. And so the STR tax loophole and even rep status only qualifies or only matters for that extra $1,000. Is that correct?
Correct. Yeah, because your rental is like, if we think about the P&L for the rental itself,
Yep.
we've got $10,000 of rental income, $7,000 of OPEX, and then we have $4,000 of depreciation. So 10 minus 7 minus 4 is -1.
Yep.
So now I cashed out $3K just from because 10 minus 7, right?
Yep.
The $4,000 depreciation is all made up. So I actually made $3K. That's money that actually hit my pocket. But I'm telling the IRS I lost $1,000. So the question of, can I use the $1,000 or not, is answered by looking at the passive activity loss rules and determining, did I qualify for one of the exceptions to the passive activity loss rules, which is real estate professional status or the short-term rental loophole.
Perfect. So appreciate the clarification. We've talked multiple times now, and I still did not realize that it was only on the additional or extra piece, and which totally makes sense, because if I made, let's say $20,000 or $40,000 in profit from my Airbnb, I want to write off all the taxes I'd have to pay on that, and then whatever's left over, I'd want to be able to use somewhere else, right? And that's really what we're going to get into right now. So,
well, and just a real quick comment on that too, because it's actually a really good point. We get clients every once in a while that are kind of new to real estate. They're either investing in a fund or they just bought their own rentals, and they'll come to us and say, "I can't believe that I don't get any tax benefits because all those losses got suspended." But what they're not realizing is, no, wait a second, I made $3,000. That's money that hit my pocket, and I'm not paying tax on that today.
Right.
And so if you want to get into all the math behind it, you add the $3,000 to your total income, but your total taxes stay the same. You have effectively reduced your effective tax rate. So that's a good thing. So even if my losses get suspended, it doesn't mean that I'm not getting the tax benefits from investing in real estate. I still am. I'm just not fully optimizing it. And that's okay too, depending on the situation.
Okay, cool. Let's go deeper into it in this next video when we go through the real estate professional status and the STR tax loophole.
Sounds good.